Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup for the last week in May through May 30th, 2014. What I've got on the screen here is a monthly chart of the SPX, the cash index. Before I jump into it, just a really quick note here. In the month of May, we've seen all the indexes finish in the green. The leader for May was Nasdaq at 3.11%, and the SPX finished up 2.1, followed by the Dow at 0.82 and the Russell at 0.68%. So this coming week, we're going to have a really interesting week. We got a lot of busy activity, and it kicks off really Tuesday early in the morning with the Australian interest rate decisions, and then we're going to get the unemployment rate early in the morning out of Europe. Then we got the GDP numbers out of Australia. And then on Wednesday, we've got the GDP out of Europe, interest rates out of Canada, and then we've got the big interest rate decisions out of Britain next week, Bank of England, and the ECB interest rate decision on Thursday, which is really big. And then, of course, we're finishing up the week with our unemployment rate in the U.S. So we got a lot of things coming up next week that are going to affect the rates. And as you saw, what's up with bonds? Where is the market going? Well, I thought the best thing to do is just to kind of take a step back. Let's look at the monthly chart here, just to kind of see where everything is. And as you can see on this monthly chart, goes all the way back to the middle 80s, early 80s. So it goes back quite a bit. What I've done is I've got a couple of things here that I think are worthy or of note for everybody to take a look at. The first thing I've done is I've shaded in, the key support and resistance zones. I got another one here, and then I got another minor one here like that. Of course, this is the major one with the big pivots that we had here. And then, of course, this is a big one right here in this area. Now, what I want to do is focus on up in this area here. We're in what I call dry powder, which basically means there's no natural price level or no natural resistance point up here. So we got to kind of rely on other types of indicators. And a good one to rely on that all of you should have access to is Fibonacci extensions. So what I did was I ran on this monthly chart, and I showed you guys probably it was early this year or late last year, some extensions on where we could go. And I used it off that pivot low and that pivot high there. The pivot low, of course, was in March of 2009 when we just fell off the table. And the pivot high was right before the crash in 2007, going into 2008 in the summer of 2007. So in using these, what I did was I plotted a Fibonacci extension on the monthly chart. And I want to show you a couple of things. You can see in doing this, I've got several here that are of note for us. One is, and I like to use the 1.236. It's a very sensitive one, but it seems like the markets always seem to pause at that number. And when I blow this up, you'll see that we go into the daily. You'll see that we did. That's at 1803. And remember, this was as we took out the 1600 levels here back in 2013. We wanted to say, well, where are the natural resistance points up here? And, the first one was projected at just slightly over 1803, which was about 215 points from that point of taking out that pivot high right there. But then the very next one, which is now going to serve as our resistance point near term, is the 38.2% extension. If you can't see that, that's at 1936.85. Okay, so that's going to serve as a natural resistance point for the SPX going up. And then, of course, another very big one here is at 50% extension. And again, that's using that, and this is our pivot low and pivot high on the monthly chart to look at that. And that next one is sitting at 2044.77. Now you may be thinking, good Lord, we're not going to get way up there. And I'm going, well, don't have that kind of attitude. Now it may take some time to go. Remember, each one of these bars is 1 month. So a year time frame is just this distance right there. That's 1 year right there, because each bar again is 1 month. But I want you to know that we're now at this level right here, which is another natural fib resistance level. So what I want to do is zoom in on this, and let's just see here. Um, um, this first level at 1803, it did provide some resistance and support for us. If we come into the daily chart, you're going to see here in the daily chart right here, this one area that did provide some resistance and support that was at that level there. Remember, we stayed here. This area right there is almost 1 month, one solid month that we spent, trying to penetrate this fib level here. We finally got some altitude. We were able to come up, but then we did a quick retest, came down. I hit a prior pivot here, and then off to the races, up, down, and then we finally got some latitude. Didn't quite make it back down again, but you can see this area here, which was the first fib extension off that pivot low and pivot high of the monthly chart, is like a magnet. And again, it's sitting at 1803. So when we pass these, either going through it to the upside or through it to the downside, it's kind of like magnet or Velcro. The prices want to hang out here for a while. And again, this is a monthly chart, so we could take a whole summer or 2 quarters to work through it. Now you can see we hit a high here this past week at 1924.03 on the SPX. That was an intraday high. And you can see that this next, where we're sitting just slightly below that key pivot high on the monthly, which is at or not a pivot high, but a Fibonacci high there that I pointed out, okay? So if we come back and look at the number again, if we look at the monthly, you're going to see there's at 1936.85. So if we come back in here and look at the daily, 1936.85 is just where this next resistance point is, sitting right at that level there. So 1936.85. Now that's not to say that everything is an exact science. I'll give it 2 or 3% on either side, which will give us a zone more like the one that I've drawn in here, like that. So we're gonna, this is going to be a natural, and again, this is a 0.38 fib extension. All right, that's what that is. That's a fib extension. Off of these prior pivot high and low on a monthly chart. So that's going to be a strong area should we get up there. And that's not to say that we will get up there, but you can expect resistance at that point if we do. The other thing that I wanted to point out, and again, this is a daily chart. We've got a high, a higher high, and a higher high. I mean, you can clearly see that. You can see here there was no bearish divergence between these two right here, none at all. So that was a good sign. I mean, this was a very valid move. That was a nice little pullback that gave us a buying opportunity to jump in, which we did. But now you can see we're at this higher high here. And should it roll, that would give us that bearish divergence here. If we look at my stochastics, or I'm sorry, the oscillator, again, which measures strength, and again, I'm looking at the daily chart here, you can see this does set up for a potential bearish divergence play if we run out of juice here. Now, on Friday, I posted in our chat room, I did a small credit spread out of the money up in this area here. I went north of the fib level, and I basically took a credit spread, kind of 1/2 of an iron condor. I'd like to see some really strong down days, and then I'll put in a credit spread with puts, a bull put spread, if you will. But for now, that was just one of the trades I put on Friday. But this is kind of where we're sitting right now. You can see that we're comfortably sitting above the 50 EMA. You can see how the 50 EMA is serving as really good, solid support here for this. And this past, for the month of May, I mean, all the SPX was not the top performer. Nasdaq was the top performer, but the SPX finished up 2.1% for the month of May. So we had a nice little move up, but we spent most of our time right in this area here, kind of chopping around, and we finally broke through in the last week and just had this nice little up move. Now, understand that there were, I would imagine, a number of stops placed in the market above this level. I suspect a lot of people didn't think we would get up above it. Right in that area there. So I would imagine some of this was when a lot of the buy stops were held, and that drove us up and kind of gave us that final 2 or 3 day push. I want to see some more new buyers come in and take us up a little bit higher. But I think we're going to be running at a little bit of steam. We're probably going to come back and test this 50 EMA again. So we certainly have a number of things coming up this week that can move the markets, primarily currencies and bonds. But we're going to see, and then towards the end of the week, we got the unemployment out of the U.S. So we got a number of big ticket items, big government monthly reports, both out of the U.S. and out of the U.K. and out of the ECB, as well as out of Australia, that can move a number of different things. So we're going to get some of that action there. So this is the SPX, as I look at it. Now, if we come back in, and let's take a look at the Russell, or I'm sorry, not the Russell, but let's look at the Nasdaq, because the Nasdaq had the best. It was the best performer for the month of May. And if we look at the Nasdaq, this is the Nasdaq futures. You can see here we've come up, and we are now hitting the prior highs that we made back in early March before we started that down move in Nasdaq. I mean, this is Nasdaq 100. This is the 100 largest companies in the Nasdaq, and you can see here on this chart where we've pretty much recovered everything just about that we gave up here. I mean, it's just this nice little pattern like this. So what we could expect, for those of you that understand technical analysis or particular patterns here, it's a little bit of a pullback and then one of these kind of things here, and then we would have a decision point right there, and this would be what would be called a cup and saucer pattern, which if we were to blow through it and go in that direction, then we could get a nice little run up for another 4 to 6 weeks. That would be a nice pattern. We can expect a little bit of a pullback here. We are at resistance point, as you can see here. So, but Nasdaq has given it up. I mean, we've really had a nice little turn here. You can see here we were making lower lows, right, and lower highs. And you never know when this thing is going to turn and roll. But we took out that this previous pivot high with that high right there, right? I mean, you can see we clearly took it out. And then we formed a new pivot low there, which was higher than that prior pivot low there. And then it took us a little bit of time, but we finally took out that high with a higher high here. And we came back down, but we did not take out this low here, so we made a higher low there, and then another higher low, and then a high here. So this is the prior pivot low. This is gonna be a key juncture for us to the downside. I'm not worried about a prior pivot high. So if we have a pullback, a pullback like this all the way down to this area here, and then a roll up is still valid. So we are now in what I would consider to be a classic uptrend as defined by the charts and price action in this way here. And it took us, I would say about 3 weeks to work through this turmoil here as we moved up with Nasdaq. Now, I'm going to show you the Russell chart, and you will see the Russell chart. We're trying to make this breakout, but we haven't really done it yet. So if we look at the Russell right here, there we go. You can see right there, there's that down move. And, there are key points, and I highlighted this last week. You can see the lower lows that we've made here, right? You can see clearly the lower highs that we've made as we come down, right? I mean, they're just lower highs. Now we made a higher high right there. This high took out that prior pivot high there. It also took out the 200 EMA, or the 50 EMA, which is sitting right there, which is a good thing. So now we would expect a little bit of a pullback coming back. If we take out the 50 EMA, we got a natural price level there. or we come down, we got the 200 EMA that's now got still a little bit of an upward trajectory to it right in that area there. And we could still come down here as long as we don't take this guy out and then we bounce, whether we bounce down there or we bounce there or we bounce there. And if we can take this guy out by making a new high in this area here, right? Now we're starting to establish, just like the Nasdaq, a channel that we can run in to the upside. We're nowhere near there yet. We're trying to define it right now. One bit of good news on this that would seem to indicate that's what the markets are starting to carve out for is we got a low here, a lower low there, but you can see the bullish divergence there. So that's a good signal, right? Now you can see these key indicators here that are going to provide support. We do not want to take out that prior pivot low. If we do, then all bets are off and we are still in this regression channel heading down. So we're still in the process now with Nasdaq. Remember, the Russell has already recaptured. The Russell, I'm sorry, not the Russell, but Nasdaq. Nasdaq has done one of these numbers like this. That's where Nasdaq is. You know, Nasdaq is way up in this area here. You can see the Russell is way down here underperforming by a wide distance. The Russell is going to be key for us, folks. If the Russell starts to give it up, the other markets are going to give it up as well. So you need to use the Russell as a benchmark. So now just remember this chart in your mind. This is the Russell. Again, I'm going to put Nasdaq back up. You can see here with Nasdaq how we are back up to the pivot high again, right? That's where we are with Nasdaq. If we look at the E-minis, the E-mini S&P 500 futures, we never even had that pullback. You can see where we're sitting here on the E-minis, and let's put in the new intraday high of the E-minis, which was made on Friday, right at that 1922.25. Okay, so on a very near-term basis, I've got a resistance point at 1926.74 using fib extensions, and then 1937, which also happens to be close to a monthly fib resistance point as well on the monthly chart. So we've got a number of things that we've got to hit overhead resistance-wise, looking to the upside. But again, this is the E-mini, and if we look at the Dow, and we look at the Dow futures, so let me just call the Dow futures up. You can see with the Dow futures right here, I'm going to just take this off because we hit a new high as well on the Dow futures on an intraday high. We closed close to the high at 16,704 right there, which is very close here. So the Dow and the E-minis, S&P 500, a completely different chart. Again, though, we've got this bearish divergence setting up here as we're making these new pivot highs like this. You know, we've got this bearish divergence. So that would tend to suggest that I would not be surprised to see us come down and test this red line, which is the 50 EMA again. All right, would not be surprised to see us do that. The Russell on the E-minis finished up 1 point on Friday. The Dow finished up 14 points on Friday. Nasdaq was down 6, and the RUT was down 7.6. So it just did not have a good day on Friday. So remember, the Russell is going to lead the way up and down. So we're starting. I think we're gonna get some key numbers out of Europe with interest rate decisions, both out of the UK and the ECB. We're gonna get something out of Australia, and we got our unemployment report. So we're gonna get some movement here. And if we look at the sectors, the strongest sector for 2014 is the utility sector. You can see here, if I just kind of box in 2014, right? This is 2014 right there, this box. And you can see the utility sector, you know, started at the bottom, tested the top, and we're somewhere near there right now. The utility sector right now, year to date, is up 9.43%. It is the best performing sector in the S&P 500. Um, and that's not a good thing. You can see just a little bit of bearish divergence setting up there. But, we've a lot of fear is back in the market with utilities running higher like this. The sector that has not performed at all year to date is the discretionary sector. And the discretionary sector, you can just say XLY. Here's the discretionary sector right here. And if I show you the, let's box in the year. This is the year for discretionary. Okay, completely different. You can see we entered the year right there, and we're right there. So we're down discretionary about 5.48% for the year. Um, Discretionary is a risk-on kind of thing. You can see how starting in March, risk started coming out of the markets dramatically. We did have a break right here in this last week, which showed some strength in the discretionary sector. That's a good sign. We had that final break, and we're getting some altitude back up. In fact, it was one of the, discretionary is one of the better performing sectors for the week. The monthly, the utility sector has been not only was the utility the best for the month or for the year to date, the utility sector was also the worst performer for the month. And the best performer for the month was technology. If we look at the technology sector, which would be Nasdaq, which would make sense, right? I mean, if we look at technology, Nasdaq just did very well for the month. And you can see here for the month of May, and I'll just block in the month of May. This is right here. That's the month of May. Um, Technology was the best performer. Now it was not up a lot, um, but it was a good performer. You can see right there the movement here, up over almost 1.66%. So that was a nice movement for technology. We had a breakout in that area. There is no bearish divergence in this higher high. So that would substantiate the strength in Nasdaq. So the other one that's been a good performer of the past few weeks, we had a breakout here. In this one right here is the Biotech. And we've been playing Biotech a little bit to the upside. You can see that solid support there. And then we had this break here. And for the past week, Biotech has had a nice little run up. It's sitting just slightly below its 50 EMA. If it starts to roll down and break that downsloping trend line, it's going to come down and test this again. But right now, the strength is above the zero line in my stochastics. And we've got a just barely neutral to slightly up bias on the Biotech on my indicators as well. So that's pretty good. Also, another very strong performer is the technology. If we look at the technology sector, it's done very well. I mean, technology is just to the roof. And just about everything in technology has been very strong. Now, the one that I want to focus on, though, and just show you guys is the bond market. You can see here the bond market had a clear move up, and we hit a key resistance level right in this area here, and then we gave it up in a day. I do believe, as I've said numerous times, bonds are going to end up back down here, sandwiched between my support and resistance point. I think we're probably going to test this upper boundary. We're going to test this area right here. But we still, we had this golden cross there, the 50 over the 200. And that tells me that we've still got a lot of bulls coming into the bond market. And you would probably say, well, gee, with the equity up, how come bonds aren't down? The one thing you got to understand, the bond market, the U.S. Treasury market is a global market. So it's not just U.S. dollars going in, but it's European dollars, it's Asian dollars. And if you look at most of the bonds across Europe, and you see Italy and France at less than 2.5% on their interest rates, or you look at some of the others, Greece and some of the others, and they're still, you can get a U.S. bond for a similar interest rate, but the risk between a U.S. bond and an Italian or a French bond, it's no comparison. So the money's going to flow into the U.S. bond market. So we've got a lot of money flowing into the U.S. bond market right now. So as this money comes in, it tends to prop this up. Even though the U.S. markets and the Feds are taking $10 billion a month out of stimulus, and if they keep doing this at this rate, by December there will be zero stimulus in the bond market from a U.S. perspective. So let's keep a tight eye on this. I do believe that this run up, what it also says that this sell-off here at this point right there was overdone. And the bond market, that's common. When we started this sell-off right there, that big down move right there was overdone. We're a little bit at that point there where we're about 50% of this entire sell-off right there. And this is why I think now it's just going to be chop. And the only thing that'll get bonds up there is if the U.S. markets start to crater. Other than that, I think the bonds are going to end up back down in this tight pattern down here again. So longer term, I'm short bonds. Very near term, it's going to be based on the daily and the weekly, the numbers that come out from a government perspective. So that's kind of where we're sitting here. And just to show you the 30-year interest rates, I mean, look at this. This is how low we've gone, and to show you just how tight this has been. Look at that right there, folks. These are key pivot points, and we broke these key pivot points, and we haven't looked back. 3.462% on a 30-year note, and now we're going to sit at this. We're at another key pivot point right there, which is right in that area right there. So if I were to extend it over to the right, I should probably extend it a little bit. You can see this is kind of where we're sitting here. If we break this area here, which it looks like it's trying to do, and we have a retest and then it fails, we're going to come down here, and that means all bets are off, and that won't be pretty for the U.S. equity market. That'll take us down to 2.8% for a 30-year bond. Not good at all. So for us and for me to really start to get more aggressive in my shorts and bonds, I want to break this downsloping trend line. That's what I want to do. I want to see it break to the upside. You can see right there just exactly where we're sitting right now. And it may take several tests, several runs at it to come up, to hit it, one of these kind of things until we finally break through. And then, take out that key level there, and then we're off to the races again, back to the upside. So I think the risk of the biggest move is to the upside, not to the downside. But that's kind of where we're sitting right now in the bond market. The other thing that I pointed out to our members, and I've been talking about shorts in this one for 4 weeks, 5 weeks, and it's turned out to be good for a lot of our traders, is this one right here, the euro. You can see the euro has just fell right off the table, so it was a good call. I talked about this thing. I know a number of our members took it, and boom, now we're testing the 200 EMA. I mentioned that the interest rate decision out of the ECB is coming next week. That's going to affect the euro. It's going to affect the dollar. It's going to affect commodities, and it will affect bonds. You're going to see all of these things tie in together. And we need to watch these very closely because we're now testing a key support area with the 200 EMA on the euro. I've also been bullish the pound. Unlike bearish the euro, bullish the pound. You can see right here in the pound, we're going to have some interest rate decisions coming out of there fairly soon, and more guidance out of the pound. You can see it sold off prior to that because up until this point they thought they were going to raise interest rates. Now there's probably talk that they're not going to raise their interest rates until Q1 of next year. But let's see how this thing fares itself out. But these have been great trades for those of us in our group that are trading these things. So anyway, folks, it's been a little bit of a longer update, but I wanted to show you where we are with this. Volatility is still very low. If we look at vol right now, you can see the chart way, way, way down here. We haven't been this low in quite some time. In fact, if we go all the way back to March of 2013, we had a low of 1105. So I'm going to plaster that on my screen right there. So that's where we're sitting. That was the low in 2013. So this is kind of where we're sitting right now. Understand when you get down to these levels, odds favor a movement up in volatility, which would generally mean a movement down in the equity market. All right, everybody, I hope you enjoyed this update. We got a lot of number of special offers out there. A lot of you have taken advantage of them. I'd like to invite you in. Check us out. We're making some really interesting, great trades for 2014. You're missing out if you're not part of the group. So come on in, check us out. Otherwise, for our members, I'll see you tomorrow night in our Secret Trader session. Have a good one, everybody. Have a great weekend. Bye now.